I would like to discuss what we have done up to now, from the session 1 to session 3. Session 1 we have fully dedicated the whole session to learn basic stuff of accounting, starting from double entry system to how you recognize a transaction, what is the reason for individual debit or credit of a account, and what are the accounts to be debited or credited, and what is the logic that you follow, and basic primary books, and users of accounting information, and what what is the purpose of using the accounting information for decision making. Stuff like that we discuss in the first session. Then we learn about basic requirements under financial accounting as far as the credit management is concerned, and how we can use the financial statement analysis for better credit decision. Then in the third session we discuss the methods that we can follow to analyze the financial statements. Under that we discuss horizontal analysis and vertical analysis, finally the ratio analysis. Now, as far as examination is concerned, you will be using the ratio analysis technique to analyze the financial statements. We discuss approximately six categories of ratios, starting from profitability, working capital, liquidity, leverage, investor relation, efficiency ratio. Likewise, we discuss different categories of ratios. And last week, last session, we commenced an examination paper that is November 2016. We partly discussed during the third session, but for the better understanding, I will discuss the entire thing again today as well, right? I hope to cover at least this 2016 paper and another paper during this 3-hour session. Right. If I go to the paper itself, according to the question, you are the credit officer of a particular bank, and there is a business organization called Alpha Business Solution. They are one of your best client, and they are leading suppliers of software solution to local and export market. Right. They have 2 facilities. Approved limit is 80 million for term loan, and current outstanding is 62 million. Whereas an approved limit of 20 million is there for an overdraft, and the current outstanding is 26 million, exceeding the limit approved. Then they are going to expand their business with a few orders that they have received, and for that the company requires additional facility of 10 million for working capital. And you are being given the financial statements, 3 years financial statement, 2014, 15 and 16 ending 31st March 31st March. The last financial statement, that is 2016 ending March financial statement, it is not yet audited. That is also point to remember. If you go through the first financial statement, that is income statement, starting from turnover, and you have the net profit after tax. Thereafter, they have put additional two line items, that is dividend and return profits. But you should know the last item of the income statement is the main item is the net profit after tax. Then balance sheet is there also. Under balance sheet, non-current asset, current assets. Then for the equity and liabilities, capital, you have a 6 million worth of share, 6 million number of shares worth of 90 million for 2014. And you have this non-current liabilities and current liabilities. And they have also given additional notes. Work in progress is the cost of work performed, not invoice, right? Then under first note, you may assume that the trade receivable and trade payable balances reflected in the balance sheet are average balances, right? Therefore, in that case, you need not to average those things again and again, right? Right. Then they have given the ratio, market value of the shares, that is 18 rupees for 2014, 19 rupees and 50 cents for 2015, and 24 rupees per share in 2016. And they have also given the ratios to be computed, starting from gross profit to the dividend yield. Sorry, I'm reading reading a different question. That is the next question. Sorry for that. Actually, this is 2016 November. You are the credit officer of Royal Bank PLC, and MS Fashion Apparel Limited is one of the leading exporters of ready-made garments. With a brand name called Butterfly, a prime customer of your bank, maintaining satisfactory current account at your bank. At present, they also enjoy following credit facilities. There are two limits, 80 million and 10 million approved. Current outstanding for the loan is 58 million. Overdraft, they have exceeded the limit, that is 16 million. And all of these 90 million approved facilities are given by the bank, taking into account 150 million value factory. That is 90 million out of 150 means 60% exposure is there. Now they need, since their product is more popular, they are going to expand their business, and they need additional machinery at an estimated cost of 10 million and additional working capital of 5 million. Altogether 15 million additional they need. Then their chief financial officer reach your bank, and they have produced 2014, 15 and 16 financial statements. And under note 1, they have given additional items, that is 2013 items also given in the note number 1. Now, in order to calculate the 2014 average balances, we need 2013 figures. That's why in the note 1, they have given the 2013 figures. we have to use these figures when we are calculating the figure average balances of 2014, right? Under note, you may assume that the overdraft interest included in the interest expenses amount reflected in the income statement is insignificant. Now, if you take the overdraft interest, that is very insignificant as per their understanding. Therefore, we need not to worry about that much of overdraft interest. Then number 2, you may use average balances for computations of ratios wherever necessary. And number 3, 90% sales are on credit basis and 10% on cash basis, right? We have to take that into account when we are calculating ratios relating to debtors. The company's stated capital is 112 million from the inception, consisting of 8 million ordinary shares. Right. Stated capital is 112 million. A recent valuation of the property indicated a value of 170 million. Now, in the first part of the question, they said 90 million worth of facilities were given against 150 million worth of valuation of the building complex and the land. Now they have taken a press valuation that is 170 million for the property. We may take that valuation, or we may use the old valuation report for the proposed facilities to be disbursed. Right, under question number 1, they want risk analysis plus the at least 15 ratios to be completed with an interpretation. First, we'll compute those things under profitability. Actually, we have started last week. Under profitability, we need to take into account these ratios. First, we'll calculate the gross profit ratio. Under gross profit ratio, you have to straight away go to the income statement, right? Go to the income statement, and the income statement, you have to take the turnover for 3 years and gross profit for 3 years, right? I took gross profit for each year and sales for each year, and divided the gross profit by sales into 100. Divided the gross profit by sales into 100. Right. Then answers will be 46%, 42.86%, then 40.78%. That is almost 46%, 43%, and 41%. There is a slight decline trend, but more or less it is above the 40% mark. We will make our comments at the latter part after we compute all the ratios. Now, when it comes to exam, you may give a interpretation in the ratio calculation itself, or you may calculate, provide a summary of ratios and provide your interpretation there also. Anyway, you will get marks. You have to give a interpretation, right? For the interpretation part, we will be allocating marks. For example, if we allocate 18 marks for 15 ratios, 15 marks for calculation part, and for the interpretation balance marks will be allocated, right? These are very easy to calculate ratios. Then the next ratio is the net profit ratio. We'll calculate that also. I'll go to the question. You have to directly take the net profit after tax. That is net profit after tax. For 2014, 39,400, 2015, 44,800, 2016, 51,200. Don't take the last item. Now, when I was correcting some papers, people tend to take the last item of the income statement. The last item of the income statement here, it is the retained profit for the year, not the profit after tax, right? Right. In order to calculate the net profit ratio, you need to take the net profit after tax. That is the last profit for the entity, right? Don't take the last item since it is the heading is income statement. Don't take that, right? Net profit after tax is the profit for the year. I took 39,400, 44,800, and 51,200, right? And divided it by sales again or the turnover, right? Then the answers will be 11.26%, 10.67%, 10.04%, right? It's almost 10, 11%, right? 2016, there is a decline in trend, but it's almost 11% to 10%. Right. For these ratios, it won't take that much of time. You have to directly take the figures and calculate. There were some questions asked by people, what kind of calculator you can use. You have to check with the IBSL. Normally, here they won't allow scientific calculators, but instead you can use a normal basic calculator, right? Anyway, you have to take a calculator. Don't use your now. If you take for assume that you do not take a calculator to the examination, then you have to use your mind to calculate all the figures. The phones will not be allowed, right? Normally people now used to have their mobile phones to calculate everything. Forget about that and take a calculator, basic calculator. And if they allow you to take a different calculator, take that also. But basically, for these things, a basic calculator will be enough, right? But anyway, you have to take a calculator for the exam. Then next ratio, we will finally do the interpretation. Next ratio is the return on equity. Return on equity. Under return on equity, you have to first write the formula, that is net profit after tax divided by average equity capital. Net profit after tax divided by average equity capital. Here, why we took the average equity capital? Because the one item from the income statement, that is net profit after tax. Then the second item is from the balance sheet, that is equity capital. Equity capital is from the balance sheet. Therefore, the one from the balance sheet needs to be an average one. If you remember that slide that I discussed, under part C, I said if the two items are from the income statement, or if the two items are from the balance sheet, no need to take any average balances. But if one item from income statement and the other item from the balance sheet, in that case, the item from the balance sheet should be used as an average balance. This ratio is that category of ratio, that is return on equity, one item from the income statement, the other item from the balance sheet. Therefore, item from the balance sheet, we have to take the average, right? Net profit after tax, you can straight away take from the income statement. We have used in the previous calculation also net profit after tax. Therefore, no need to worry about that item. You have to directly take that thing. Then, in order to calculate the average equity capital, you have to have the beginning equity capital and the ending equity capital, right? I have taken the figures, but I will show you how I took those figures, right? Equity means what? Equity means whatever the entitlement for the shareholders, right? Entitlement of the shareholders will comprise mainly of two parts, that is stated capital and the reserves. Stated capital and the reserves, right? We'll go to the balance sheet in 2014, 2015 and 2016 and try to calculate the beginning equity and the ending equity. Here I mentioned equity means stated capital plus reserves. Stated capital plus reserves, right? For 2014 year, the beginning equity means 2013 equity, right? Here 2014, the beginning equity means 2013, 31/3/2013 balance equity. Ending equity 2014, 31/3/2014. 2015, the beginning equity means 2014 balance. Similarly, for 2016, the beginning equity means 2015 balance, right? That's why here you have 115,400 ending, 2015, the beginning, the same balance. Here, 2015 ending 128,200, 2016, the beginning one is also same, right? Now we'll go and check how these figures arrive. 2013 one, 92, and 2015, 115, 400, right? First, we'll calculate this 92,000. I mentioned this is 2013 ending equity. 2014 beginning means 2013 ending equity. For 2013, to calculate 2013 figures, under note 1, they have given the figures. Now, I mentioned equity means stated capital plus reserves. Stated capital plus reserves. Right. I will go to the note number 1. Under note number 1, take the stated capital. Now, if you go to the balance sheet, right? If you go to the balance sheet, the stated capital is given. Stated capital is 112,000. Every year 112,000, and in the note number 4, they have mentioned the company's stated capital is 112 million, 112 million from the inception. From the inception, it was 112 million. $112 million. Therefore, stated capital for every year 112 million. There is no issue. Then we have to know stated capital plus reserves. What was the reserve portion for 2013? Right? Now, stated capital we have found for every year 13, 14, 15, 16, every year 112 million. There is no issue. Then we have to see in 2013 in what was the reserve balances. Now, under note number 1, they have given this retained earning. Retained earning 20 million loss. 20 million loss. Right? They have given the figures in thousands. If you take 20,000 in 1,000, that means 20 million. Right? 20 million, the reserves or the retained earnings, 20 million loss. Therefore, you have 112 million here, 20 million loss. Right? Therefore, the equity part will be 112 minus 20 million. 112 minus 20 million means 92 million. That's why I put here 92 million. At the beginning equity, as the beginning equity of 2014, that is ending equity of 2013, 92 million. Right? 92 million or 92,000 in thousands. Right? Then ending equity of 2014. Ending equity of 2014, I mentioned 115,400. Now we will see how it has been arrived at. 115,400. Go to your question. 2014 balance sheet. Now here 2014 equity means stated capital plus reserve. Stated capital 112 million every year, right? For retained earnings, they have 3,400. Therefore, altogether 115,400 is the ending equity. 115,400 is the ending equity. Right. That's why I put here for 2014 ending equity is 115,400. 115,400. Then you take the total and divided it by 2. That's your average equity capital. That's your average equity capital. That is 103,700 for 2014. 103,700 for 2014. Right. Go to the next year. 115,400 is the ending equity 2014. That will be the beginning equity of 2015. Beginning equity of 2015. 115,400 is the ending equity. It will be the beginning equity of 2015. 2015. Then we have to calculate the ending equity of 2015. Ending equity of 2015. How you calculate? Take the 2015 end balance sheet and take the stated capital and reserves. I'm going to the balance sheet again. 2015 capital is stated capital is 112,000 and the retained earning is 16,200. Therefore, the ending equity is the addition of those two. That is 128,200. 128,200. Right. I am putting that figure here and take the addition of these two and divided it by 2. Then you have your average equity for 2015. 2015 average equity. Very easy to understand and easy to calculate if you know the logic well. Right? If you take into account the correct point, then it will be very easy to understand and easy to calculate. This ending equity of 128,200 of 2015 will be the beginning equity of 2016. Beginning equity of 2016. Then we have to calculate the ending equity of 2016. Go to balance sheet. 2016. Here 112 is the stated capital. The retained earning is 27,400. Then ending equity is 139,400. 139,400. I took that figure here. 139,400. Take the total of these two, that is beginning equity and the ending equity of 2016. Then divided it by 2. Then your average equity will be 133,800 for 2016. Now you have calculated the average equity for each years and you have the net profit after tax for each years. Divide the net profit after tax by average equity for respective years and into 100. Then you can calculate the return on equity, that is 3799, 3678, 3827. 3799, 3678, 3827. Right. In a question paper, if you are not given figures to calculate the average equity, in that case, you may use the year-end figures. Year-end figures. That is, you need only to take these 3 figures. Don't calculate it. If you are not given the 2013 figures here, you cannot calculate 2014 figures. Average ones. In that case, you have to take the year-end figures and make the calculation. Right. If you do have questions, you can disturb me and ask that question. Right. We'll go to the next ratio. We'll do the interpretation part at the end. Next ratio is return on capital employed. Return on capital employed. Right. How do you calculate the return on capital employed? You in this ratio, you take not only the equity, you take the debt capital also. Right. And you, since you are taking the debt capital, we have to take the profit before interest. Profit before interest. That's why in the ratio itself, it shows net profit before tax plus before interest, and divided by average capital. Average capital means average equity capital plus average debt capital into 100. Since this is also a ratio that we conduct one item from the income statement and other item from the balance sheet. Therefore, the balance sheet item should be an average one. Right. First, we take net profit before tax from the income statement. If you go to the income statement, net profit before tax is there. Here, net profit before tax. Before tax, 56,400. If you want the item, what we want, it is there here. Profit before interest and tax, 69, 73, and 80,000. This is the line item that we want, but here I make it one line item addition. That is, we took net profit before tax and add the interest. Right? If you want, you can directly take net profit before tax and interest. Right? Here it is given 69,000, 73,000, and 81,000. Right? Right. Then average equity capital. In order to calculate the average total capital, you have to have average equity capital and average debt capital. Here, average equity capital we have already calculated in the previous ratio analysis. Right? In the previous ratio, we have already calculated average equity. Now go to the previous return on equity calculation here. Average equity capital we have already calculated. Therefore, no need to calculate again. You can use these figures in the second calculation. 103, 700, 121, 800, 133, 800. I took the same figures. Right here, 103, 700, 121, 800, 133, 800. Right. Then you need to calculate the average long-term debt capital. Average long-term debt capital. Right. In order to calculate average long-term debt capital, we need to have the beginning long-term debt and the ending long-term debt. Here 2014, the answer is average long-term debt capital is 65,000. Now I will show you how I calculate this 65,000. Go to your question paper. Now go to balance sheet. First part, first note, there term loan is 50,000. Under note number 1, 2031 3 31 3 2013, 50,000 long-term loan was there. That is the beginning long-term loan in 2014. Then 2014 ending long-term loan is 80,000. Here 2014 long-term loan is 80,000. The ending one is 2014 ending one is 80,000. Beginning one is here 50,000. Therefore, you have to add 50,000 and 80,000. Then it will be 130,000 divided it by 2. That is 65,000. That's how this 65,000 we calculate. Here 65,000. Now I calculate for 2015 also. 2015, 74,000 is the answer. Now we'll see how it was calculated. Go to your question paper. 2014, 80,000, 2015 and 68,000. Add those two items, that is 80 plus 68, that is 148. 148. Divided it by 2. 148 divided it by 2, 74,000. 74,000. Here, 74,000. Similarly, for 2016, go to the question paper, 2016. Here, 68,000. Here, 58,000. 68, 58, altogether 126,000. 126,000. 126,000 divided by 2, that is how much? 126 divided by 2, 63,000. 63,000. Here, 63,000. Right. Now, average equity capital is there, average long-term capital is there. You have to add those two. That is average capital employed. Average capital employed. For 2014, 168,700, 2015, 195,800, 2016, 196,800. Right? Then take the net profit before interest and tax, this line item, and divided it by the average capital employed, this line item. Then you have these figures, that is for 2014, 40%, 40.9%, 2015, 37.28%, 2016, 41.16%. Right. If you do have questions, you can disturb me and ask those questions. Right. Next ratio under profitability, that is return on assets. Return on assets. I mentioned when we were discussing these ratios, return on asset, you can compute using the before tax profit or after tax profit. Before tax profit or after tax profit. Now here I am calculating return on assets after tax. Return on assets after tax. Take the net profit after tax. Take the net profit after tax. That is 39,400, 44,800, 51,200. That is net profit after tax. Then take the total asset figures. Total assets beginning, total assets ending. Directly go to the balance sheet. If you go to the balance sheet, total assets here. Total assets beginning, total assets ending. For 2014, you have to take the average figure. Now, since this is also one figure from the income statement, another figure from the balance sheet. Therefore, the balance sheet figure should be average one. For 2014, ending figures are here. 2014, 2015, 2016 ending figures you can directly take from the balance sheet. Now, 2014 here, 228,500 to 241,000, 252,000. Right? I took those things directly from the balance sheet. Here, ending ones. For beginning one for 2014, you have to go to the node number 1. Under node number 1, it was given total asset figure is 180,700. 180,700. I took that here, 180,700. Now, 2015 beginning one is 2014 ending one. Similarly, 2016 beginning total asset figure will be the 2015 ending total asset figure, right? For individual years, take the total and divided it by 2. Then you have your average total asset figures. Average total asset figures. Then take the net profit after tax, divided it by average total asset figures, and calculate the ratio. Return on assets. Return on assets. For 2014, it will be 19%. 2015 also 19%. 2016, it will be almost 21%. Now, I mentioned when I was discussing for banks, this ratio will be at a very low level, that is 1% or 2%, right? If a bank has a 2% return on asset profit after tax, that is a very good bank, right? Normally, if you do have 1 trillion total assets, then to get a 1% return on asset, you have to have a minimum of 10 billion profit figure. If you do have 20 billion profit figure with a 1 trillion total asset, then it will be 2% only. That's why I mentioned 2% is very attractive and very good ratio for a bank. Now, in 2020 figures, because almost all the banks have recorded decreased profitability in 2020 because of this pandemic, all the banks, this ROA, they have it has been reduced up to 1%. But in a normal business organization, don't worry about a bank. Now you are going to lend all these loans to normal business organization. In a normal business organization, it will be more than 10%, right? In case of a banks, normally the total assets have been financed 90% by the deposit holders' money. That's why we do have in banks a huge number of total assets compared to other industries' total assets. Because other industries won't get that chance. They have the only way that they can finance their asset is there are two ways. Either the shareholders will have to put the money, or these borrowers will have to put the money. But in case of a bank, other than the shareholders and the borrowings, they have an option called deposit holders money, right? Free flow money from the deposit holders, that is also there. That's why their balance sheet are huge compared to other industries' balance sheet, resulting a lower return on asset. Resulting lower return on asset. Right, we'll go to the next ratio under profitability. That is interest cover. Interest cover. Right. How do you calculate the interest cover? You have to take the net profit before tax, before interest, before tax, before interest, then divided by interest portion. Right. Net profit before tax, I have taken from the income statement directly. That is 56,400, 56,800, 60,200. Here, no need to take any average balances since all the figures, both figures are from the income statement. Net profit before tax plus interest and the interest. All are from the income statement. Therefore, just take the figures and calculate. No need to take the averages. Net profit before tax 56,400, 56,800, 60,200 respectively for 3 years. Then you took the interest from the income statement directly. 12,600, 16,200, 20,800. Then add back those two. That is net profit before tax plus interest, 69,000, 73,000, and 81,000. Then divided it by the interest figure itself again, right? Then you have a number of times figure. That is 2014, the times figure is 5.48. Then 2015, 4.51. 2016, 3.89. Now, when we initially learned about this interest cover ratio, we said higher the number of times, better it is. Higher the number of times, better it is. Here you can see a decline since the profit is not that much increasing, whereas the interest figure is getting increasing, right? Compared to the increase percentage of profit figure, the interest figure is increasing higher. That's why you are getting a lower interest cover number of time figure. Higher the figure, better it is. I think there is no much difficulty in calculating this ratio. Right, we'll talk about the interpretation part finally. Right. We'll go to the next category of ratio, that is liquidity ratios. Very easy to calculate. Two liquidity ratios, current ratios and quick asset ratio. First, we'll take the current ratio. For current ratio, you have to take the balance sheet figures, that is current assets and current liability. Go to your balance sheet. Go to your balance sheet here. You have to take the current assets and current liability. Current assets 51,500, 68,000, 84,000. Current liabilities here 33,100, 44,800, 54,600. Very easy to calculate, right? Then divide the current asset figure by current liability figure. That is 51,500 divided by 33,100, right? Now, in this ratio, we say for every one current liability, what is your current assets position? For every one current liability, what is your current asset position? That's why we divide current assets by current liabilities. Now, if you take 2014, in 2014, for every one current liability, you have 1.56 current assets. 1.56 current assets. Similarly, in 2015, for every one current liability, you have 1.52 current assets. In 2016, for every one current liability, you have 1.54 current assets. Now, the ratio is almost 1.5 for every year. Normally, for our understanding is one current liability, you should have at least two current assets. But here, they have maintained 1.5 position. Right. We'll do the interpretation once we compute all the ratios. You need not to write down anything. It's better to understand and better to listen to whatever the things that I am going to speak about and get a clear idea how to calculate. Then I'll tell you how to interpret and finalize the answer. Right. Then we'll go to the next ratio under liquidity, that is quick asset ratio. Quick asset ratio. In order to calculate the quick asset, you have to first take the current assets and you have to remove from the current assets in order to calculate the quick assets, the inventory, right? I took the current asset for individual years. Here also no need to take any average figures since both figures are from the balance sheet. I took the current assets. Then I took inventories. From the current assets, deduct the inventories. Then you have what is called quick asset for 2014, 33,000, 2015, 44,000, and 2016, 52,000. That is quick assets. Then divide the quick assets by current liabilities. Divide the quick assets by current liabilities. For 2014, you have for one current liability, you have one current, one quick asset. For one current liability, you have one quick asset. Similarly, 2015 for one current liability, you have 0.98 current, quick assets. In 2016, for one current liability, you have 0.95 quick assets. Normal acceptable ratio is 1:1, but this company also maintain that ratio almost 1:1. These ratios are very easy to calculate. Don't make any mistakes when you are writing your answers in the exam, right? Don't make any mistakes, right? I am trying my level best to pass everybody in the in this course to get through the exam, but there are some people, they are willingly try to get don't get they are try to fail the exam, right? Those people, I am not given any chance to pass the exam. I am not given any chance to allocate any marks, additional marks to the examination paper. Their purpose is to fail the exam, right? Now they make these kind of silly mistakes. Therefore, all these ratios calculated up to now, very easy to calculate, very easy to understand, right? For the calculation part, don't make any mistakes. There may be mistakes can be done when you are going to interpret and when you are going to risk position, when you are going to structuring facilities. There can be mistakes, but for the calculation, it's very straightforward and you need to calculate. If the examiner gives details for you to calculate average balances, then you can use. Otherwise, use the year-end figures. Then we have finished with the liquidity ratio, that is current ratio and quick asset ratio. We'll go to the next category, that is working capital ratios. Here, I'll skip this ratio inventory turnover. Instead, I will use the next ratio, that is inventory turnover period. This is very easy to calculate. No need to calculate the both ratios, inventory turnover and the inventory turnover period. We have to calculate one ratio. I recommend for you to calculate this, the second ratio. That is very easy to understand and easy to calculate from your side. That's why I skipped that previous one. Now here, the question is inventory turnover period, right? What is the formula? You have to take the average inventory, divided it by cost of sales into 100. Why we took the average inventory? Because cost of sales is from the income statement, inventory is from the balance sheet, right? In that case, we have to take the balance sheet figure as average one, right? Average inventory and the cost of sales. First, we will take the cost of sales. Go to your question. In the income statement, cost of sales is very easy to find. Here, 189,000, 240,000, 312,000. Sorry, 302,000. Right? I took those figures directly from the income statement. Then, in order to calculate the average in order to calculate the average inventory, you need to have the beginning inventory and the ending inventory. For 2014, the beginning inventory will be the 2013 one. Go to your node number 1. Under node number 1, ending inventory, you can directly here, ending in inventory, these three figures you can directly put there. 18,500, 24,000, 32,000, right? Here I took those figures here, ending inventory. For 2014, the beginning inventory will be 2013 beginning ending inventory. Now go to node number 1. They have given the inventory figure as 2013 ending inventory 15,500. 15,500. I took that figure here. I took here as the beginning inventory of 2014. Then here 2015 beginning inventory is the ending inventory of 2014. Yeah. Similarly, 2016, the beginning inventory is 24,000. That is the ending inventory of 2015, right? Right. Then calculate the average inventory by adding these two and divided it by 2. Then you can calculate the inventory turnover period. Inventory turnover period. That is average inventory divided by cost of sales into 365. The answers will be 33 days, 32 days, and 34 days. 33 days, 32 days, and 34 days. Meaning the inventory turnover period will be almost 1 month. 33, 32, 34 means almost 1 month. Meaning your inventories will be there as inventories at least for 1 month before them converted into sales. The lower the period, better it is, right? Lower the period, better it is. Now in this company, the inventory will be remain as inventory for at least 1 month before them making into sales. If it is 15 days, that is better. If it is 7 days, that is more better. If it is 1 or 2 days, that is the expected. Your inventories will only last for 1 day as inventory before them making into sales. Now here in this company, it will inventories will be last for at least 1 month before them taking into sales. If you do have any questions, you can ask. Otherwise, we'll go to the next category of ratios. When next ratio under the working capital. Right. The next ratio is debtors collection period. Debtors collection period. Here also you have to listen to me very carefully. Debtors collection period, how do you calculate? You have to take the average debtors, divided it by credit sales into 365. Go to the here, the formula is given. Average debtors divided it by credit sales and into 365. Average debtors divided by credit sales into 365. Now first we'll take the credit sales. Now in the question under note number 3, they said 90% of the sales are on credit basis. 10% of the sales are on cash basis. Right? 90% of the sales are on credit basis. 10% of the sales are on cash basis. Now, how do you calculate the credit sales? You have to take 90% of the sales. Right? Now, here 2014 figure, credit sales, go to your income statement. Under income statement, you have sales turnover. I took 90% of the 350,000. The 90% of the 350,000 is how much? 315,000. Similarly, 90% of the 420,000 is 378,000. Same way, 90% of the 510,000 is 459,000. That's how I took the credit sales figure. Then in order to calculate the average debtors, you have to have the beginning debtors and the ending debtors. Right. Ending debtors, very straightforward. Go to your balance sheet. Ending debtors, go to your balance sheet. Here, receivable. Receivable means debtors. Ending debtors is 27,000, 36,000 and 42,000 respectively. You take that ending data, 27,000, 36,000 and 42,000. Right. Then the beginning data for 2014, the beginning data of 2014, you have to go to node number 1. Under node number 1, the trade receivable figure is 25,000. 25,000. I took that figure here, 25,000 here. Then add these two, divided it by 2, then you have 26,000 as the average data. Similarly, this ending data for 2014 will become the beginning data of 2015. This ending data of 2015 will become the beginning data of 2016. Similarly, you have to add these two and divided it by 2. You have these figures of average debtors. Average debtors. Now you have average debtors and credit sales. Divide the average debtor by credit sales into 365. Right? Then you can find 2014 30 days, 2015 30 days, 2016 31 days. Meaning your debtors are taking at least 1 month to repay your debts. Debtors are taking at least 30 days to repay their debts. The lower the number of days, better it is. But here the debtors of the company, they are taking 30 days to repay. But there is no much change in between the 3 years. We'll make sure at the interpretation how we interpret these figures. Right. Next one is creditors payment period. Now here we have some complexity here, but we can calculate the whatever the figures using the data available. Now if you go to the formula, credit payment period equal average creditors divided by purchases. Average creditors divided by purchases into 365. Right? If you go to your income statement, the purchases figure is not given. Here, you have only given the turnover, cost of sales, and gross profit. Right? They have not given the purchases figure. From using the cost of sales, you know, cost of sales will be arrived at by adding the beginning inventory and the purchases and deducting the ending inventory. Right? How do you calculate the cost of sales? First, you have to add the beginning inventory to the purchases, then deduct that amount, deduct the total of that those two from the closing inventory. Then you have the cost of sales. The formula is beginning inventory plus purchases, deduct closing inventory, then you have the cost of sales. Now here you have the cost of sales and the beginning inventory and the ending inventory. Then you have to calculate the purchases. Purchases have not been given. You have to calculate that thing. But you can calculate, normally we calculate the cost of sales. Cost of sales equals beginning inventory plus purchases minus closing stock. I repeat, cost of sales equals beginning inventory plus purchases minus closing stock. Then you have cost of sales. Now here in the formula, the cost of sales also given, the beginning inventory also given, ending inventory also given. We have to calculate the purchases. Right? if you again rewrite the formula in order to calculate the purchases, it will be like this, right? The original formula is cost of sales equals beginning inventory plus purchases minus closing stock, right? Now, now you want to calculate the purchases, right? In that case, you have to keep the purchases in that side and take other two into the other side, right? In that case, when you rewrite the formula, purchases will be equal. Purchases will be equal cost of sales at closing stock minus beginning stock. At closing stock minus opening stock, right? Using that methodology, we can calculate the purchases. Here, I took the cost of sales figures, right? Cost of sales figures. Then I took the inventory figures beginning. This is also you can take from the balance sheet. Here 15,500 for 2015. I took it from the note number 1, beginning inventory. Then in ending inventory, you can straight away take from the balance sheet, and the ending inventory of 2014 will become the beginning inventory of 2015. Right? I need not to explain these things because we have already used these figures in the previous calculations. I took the cost of sales. I took the beginning inventory for respective years. Then ending inventories for respective years. Now here the trick. Normally we calculate cost of sales. When we are calculating the cost of sales, we add purchases and beginning inventory and minus the ending inventory. Now here, now we have to reverse back. In that case, cost of sales, you have to minus the beginning inventory and add back the ending inventory. That's how you calculate these figures of purchases. Right. To take 192,000, it will be, you have to add to cost of sales the ending inventory 18,500 and deduct the 15,500. If you take these, the difference between the beginning and the ending entry, the difference is 3,000. Right? 3,000 add. That's how this 192,000 come to light. 189 plus 3,000, 192,000. Here in the formula, ending inventory we add, beginning inventory we deduct. Similarly, you can calculate purchases figures for every year. Right. Then you have purchases figures. Then you need to have average creditors. Since this is a formula that we are using, one figure from the income statement, one figure from the balance sheet. Therefore, the average figure should be taken from the balance sheet. Here creditors, the beginning creditors for 2014, you have to go to note number 1. Under note number 1, the creditors beginning figure is given. That is ending figure of 2013. That is trade payable 22,700. 22,700. I took that figure here. 22,700. Then ending figure is, you have to go to the balance sheet and take those figures. Creditors, it's given in the balance sheet. If you go to the balance sheet, here under trade payable, under current liabilities, 24,100, 32,200, 38,600 is there. Right. Then take the total and average it up and calculate the creditors payment period. How do you calculate? You take the average creditors, divided it by purchases into 365. Then the answers will be here here the correction should be made. Here this formula should come here. Average creditors divided by purchases should come here. Erroneously, I have given the debtors payment period formula, the last item. Subject to that, here this line item should be corrected as average creditor divided by purchases into 365. I use the same formula that we used to calculate the debtors payment collection period. But anyway, the answers will be 44 days, 42 days, and 42 days. That is, from the company side, company is taking at 44 days to repay their creditors. 44 days to repay their creditors. Here, I won't say the higher the number of days, better it is, but it will be subject to various qualifications. If it is a better credit terms dominated by the company, and they are in a position to extend their credits, then it's good. But if it is due to the company is not having enough cash to repay their creditors, that the period extending is not good. And we have to see what are the actual reasons that this period is extending for creditors. Right. If you do have any question, you can raise. Then we go to the efficiency ratios. Here also one figure from the balance sheet, one figure from the income statement. Therefore, the figure from the balance sheet, you need to take the average one. Here first we take the asset turnover ratio. Take the turnover directly from the income statement. It's given income statement. Then total asset average figure we have already calculated in the previous formula. You can directly take that figure also, beginning in total assets and ending total asset. For 2014, the beginning total asset figure we can take from the first note, that is 180,700. Right? Then calculate the average one and calculate the figure. Here the ratio is computed in terms of number of times. Higher the number of times, better it is. Turnover divided by total average assets. Higher the number of times, better it is. Meaning using your turnover, number of times you can purchase your total assets. Using your turnover, number of times you can purchase your total assets. Right. That is the interpretation. Higher the number of times, better it is. There is an increasing trend here. The next ratio under efficiency, that is non-current assets to equity. No need to take any average balances since both items are from the balance sheet. Directly take the non-current assets and shareholder equity. Shareholder equity and the non-current assets is given in the balance sheet. Divide the non-current assets by shareholder equity. Here the focus is compared to equity. What is your non-current assets position? If it is higher, then the better it is. Using your equity, the number of non-current assets that you have purchased. Now, for a company to survive in the long run, you should have a sufficient amount of non-current assets. Therefore, here the efficiency is calculated compared to your shareholder equity, whether you have increased your non-current assets or not. Right. The higher the ratio, better it is. These are very straightforward ratios. You have to just calculate, and we'll see how these things will get interpreted in the latter part. Then I need your focus on these two ratios, that is gearing ratio 1 and gearing ratio 2. In the exams, I repeatedly telling most of the people are find it very difficult to calculate these two ratios, gearing ratio 1 and gearing ratio 2. Right? I don't know why, because these ratios are very easy to calculate. You have to just take figures and calculate. Now, how do you calculate the gearing ratio 1? That is long-term debt to equity capital. Long-term debt to equity capital, no need to take any average balances. Here, gearing ratio, you don't need to take any average balances because both figures are from the balance sheet. Now, we are worried about under gearing the capital structure of the company, whether it is an ungeared company, whether it is a high-geared company or low-geared company. How much the company will depend on the equity capital and the debt capital, right? Long-term capital, go to your balance sheet. Long-term capital, what we took is only the term loan here, 80,000, 68,000 and 58,000. Long-term loan, non-current liabilities, right? We took the long-term loans, 80,000, 68,000 and 58,000. Then equity capital, go to your balance sheet. We directly took the total of the stated capital and the retained earnings. Here, 115, 400, 128, 200, 139, 400. Right. Then divide the long-term debt by equity capital. If it is less than 1, then you say low-geared company. If it is more than 1, then you say high-geared company. Your equity capital is more than the debt capital, right? That's how you interpret. In all three cases, your equity capital is more than the debt capital. Therefore, this company is a low-geared company. Low-geared company. I don't know why most of the students find it very difficult to calculate these ratios. I don't have any reason to, I don't find any difficulty in calculating these ratios, especially the gearing ratios. Most of the people are losing their marks under this category, gearing ratios. Then we'll move to the next category, next ratio under gearing, that is gearing ratio 2. Here, right, here, the formula is you have to take the total debt capital and total capital. Total debt capital compared it with the total capital. Right? How do you calculate the total debt capital? First, you took the take the long-term debt capital. Long-term debt capital we have already taken in the previous thing here. Long-term debt capital, 80,000, 68,000 and 58,000. Right? You have to take that thing here under second gearing ratio. First, we took the long-term debts. Then short-term debts, when you come to short-term debt, you have to go to the current liabilities. Here, you have to only take the debt nature of the liabilities. Now, normally we are not talking about as a debt for creditors, right? Creditors, we are borrowing them from in a short term, but we are not considered that aspect as a taking a debt, right? Now, when you are taking a debt, it should be from a financial institute, right? Therefore, for short-term debtors, we normally take only the bank overdraft and short-term loans. Bank overdraft or short-term loans are there. We take that thing, right? Therefore, go to the ratio. We only take the bank overdraft for each of these years under short-term debts. Then you have your total debts, long-term debts plus short-term debts. Then the equity capital we have already taken from the previous slide. That is equity capital, stated capital plus reserves. Then total capital, equity capital plus total debt capital, right? Addition of these two. Addition of these two. Total capital, right? Then divide the debt capital, total debt capital by total capital. Total debt capital by total capital. Then you have answers 0.44, 0.39, 0.35. Here, your total capital is 100. Your debt capital is 44% in 2014. In 2015, your total capital is 100. Your debt capital is 39%. Therefore, again, less than 0.5, meaning low geared company. Low geared company. You are more relied on equity capital than the debt capital. You are more relied on the equity capital than the debt capital. Right. I hope the gearing ratio 1 and gearing ratio 2 is very clear to you. Then we'll move to the some investor relation ratios, that is earning per share. How do you calculate? Net profit after tax divided it by number of shares. Net profit after tax divided it by number of shares. Now, straight away go to the income statement. Income statement, you have net profit after tax here. Net profit after tax. Net profit after tax 39,400, 44,800, 51,200. 39,400, 44,800, 51,200. The number of ordinary share here, I find most of the people, they make mistake here also. Now I took here 8,000, right? But if you read the question here, now it says number of shares here. Under note number 4, the company's stated capital is 112 million from the inception consisting of 8 million, right? Here, this is very common sense. Net profit after tax, we took these figures as thousands. 39,400. Now, if you take as millions, 39,4 millions, right? Similarly, this 8 million ordinary shares you have to take as thousands, right? If somebody puts here 8 million, say 8 and 6 zeros, then your ratio will be very different. It will be, instead of this 4.93, it will be 0.493, right? Therefore, don't make those silly mistakes. Now, if one item is in 1,000, the other item you should take that as also thousands. Don't put here 8 and 6 zeros. Then your answers will be wrong. But anyway, I am giving some marks, but you cannot get the full marks. Your this EPS will become less than rupee amount. That is 0.0493. Therefore, it's very those things you need to understand very carefully. Those are very common sense. Therefore, need not to waste your marks for these kind of mistakes. Right. Then earning per share. This is expressed in rupee terms. Rupees 4.93, rupees 5.6, not rupees 6.4. higher the rupee value, better it is. Now there is an increase in trend as far as this company is concerned. An increase in trend is there. Then dividend per share. Now here, go to your income statement. And the income statement, they said they have declared these dividends: 16 million, 32 million, and 40 million. I took that amount directly, and I took number of ordinary shares, 8 million, and dividend per share is 2 rupee per share, 4 rupee per share, and 5 rupee per share. From the shareholders' point of view, the higher the dividend, better it is. But from the company's point of view, when you are declaring dividend, meaning you are taking your funds of the company to outside parties. Therefore, the retention things is very less. Then you have to have for additional project, you have to have borrow loans or issue new shares, new other things you have to do. Right? In that case, from the point of view of the company, the declaration of higher number of dividend is not good. Right? You have to satisfy your shareholders. Similarly, you have to retain something for future users of your business expansion project. Therefore, it's better you have to have a particular dividend payout ratio than a higher one. Right? You have to make a strike between the satisfaction of shareholders and the company's future. You have to balance that thing. Then dividend cover, how you calculate the dividend cover? You have to take the net profit after tax, divided it by dividend paid. Then from the dividend, from out of the net profit, you covered only 2.6% to it number of times, 2.46 times, 1.44 times, 1.28 times. Right? This is how you calculate the dividend cover ratio. Yeah, you have increased your dividend, but compared to the profit increase. Now in 2014, you have 16,000 dividend. Now it has been almost triple in 2016. But you have not triple your profit in 2014, 39,400. You have not only double your profit. From the perspective of shareholders, the lower the number of times, better it is. But from the company's perspective, paying higher dividend is not good at all. Now we will summarize all the ratios that we have calculated. Starting from the profitability ratios, we have calculated 5 ratios, that is gross profit, net profit, ROE, ROCE, and interest cover. I propose you to have this summary in your exam also. After that summarization, you can do your interpretation also. First calculate, then summarize the ratios under each category and do the interpretation. Similarly, working capital and efficiency ratios, we have calculated different ratios. It's given. Then under liquidity and gearing, we also calculate under liquidity 2 ratios and gearing under 2 ratios, under gearing 2 ratios. We'll make some interpretation there. Finally, the investor relations, EPS, DPS, and dividend cover we have calculated. Right. Now, when the examiner asks you to calculate ratios, you take your choice. And if the examiner given some ratios for you to calculate, don't select your ratios. Calculate all the ratios given in the examination paper itself. Right. Now we are going to interpret.
starting from the profitability. Now I have put these points. You can make a guideline when you are answering your papers. It may be seen that both GP NP ratios have decreased over the last 3 financial years. Now, if you go to the summary, profitability, your GP increasing and NP also increasing. Now, we have taken that point into consideration in our interpretation. It may be seen that both GP and NP ratios have decreased over the last 3 financial years. This may be attributable to the fact that cost escalating at a higher pace compared to sales. In compared to sales, the company's cost is escalating or increasing. Management should take steps to control cost or increase price to restore higher GP ratio. There are two options. Either you have to increase your sales prices or you have to decrease your cost. The first option I won't recommend, because when you increase your sale prices, your sales will get dropped. You are doing business in a competitive environment. You cannot in an isolation increase your price, right? It's very easy to say you have to increase your sales price, but it will affect the selling or sales of the company. The best option is to curtail your cost as far as possible. Through that, you can increase your gross profit ratio. For net profit ratio, apart from the main cost, other cost item, that is under selling and distribution and administration and finance expenses, you can control, right? In 2020, most of the companies, they have made their efforts to control cost. They have cut their marketing expenses, promotion, budgeting, promotions, selling and everything. And if you go to the other side, some companies cut their staff costs also, right? If you go to these airlines, most of the airlines that now they have completely shut down their airline companies. Most of the staffs are now doing, they have given compensation and closed down. And some companies, they have cut down their training. Everything is happening in 2020 in order to curtail your cost, because income is not coming. Banks also did some drastic changes to their cost structures also. I don't know, for my knowledge, they have not touched the staff cost. All employees have given their bonuses, salaries, everything as agreed. But as far as the other overhead costs are concerned, they have made material steps, significant steps to reduce those things, because there was a huge income drop. One side there was no loan growth, and the other side there were decrease in WPLR, and the other side the company central bank made some clear reduction in fees and other charges, and there were cap interest rate introduced by the central bank for pawning, credit card, and likewise there were closed downs, lockdowns in branches in 2020. I suppose a good at least 5 to 6 months. The whole country was locked down, and due to those things, there were material leakages and material reduction in income side. Therefore, almost all the banks had to react for those things in order to maintain the profitability. When you are not getting income, you have to curtail your cost, right? in an interest reducing scenario, the advances will get repriced immediately, but it will take some times to reprice the deposits. Therefore, bank had a very difficult, challenging year in 2020. 2021 also in similar manner. We are yet to see any progression because the pandemic situation is still there. The business are not at their level best. Therefore, banks are also find it difficult in order to make recoveries, putting still the lower interest regime is there. Therefore, banks also had a very tough 2020, and 2021 will also going to be very tough, right? In the coming back to the question, this company will have to make other cost curtailment as far as because their NPA and GP ratio is getting reduced, right? Then it may be noted both ROE and ROCE, although decline in 2015, improved in 2016 due to decline in borrowings. Now, if I go to that thing here, ROC and ROCE, there was some decline in 2015, but it has been increased. That is a good trend. That is a good trend. Therefore, no need to worry about those two ratios. Then interest cover decline over the period, but above accepted level. Interest cover, if you go to interest cover here, in 2014, the company was in a position to repay the interest 5 times, almost 5.5 times using their profits. But in 2016, it has been reduced to 3.89. That is, say 4 times, right? There is a reduction, but it is acceptable. But the company now this will happen because your interest cost is increased and your profit is not increased in that way, right? That's why you have a reduction in or a decline in this interest cover ratio. Therefore, there is a worrying sign from the bank's point of view, because the in 2014 the company can pay using their profit 5.5 times the interest. Now it has come down to 3.89 times in 2016. Therefore, that is a one factor we need to worry when you are recommending facilities to this particular company. Right. We discuss about the profitability, then we'll go to liquidity. Under liquidity, the liquidity situation was almost near norms in the 3 financial period. We'll go to the liquidity sheet here. Current ratio, normally acceptable norm is 2:1, and quick asset ratio 1:1. Here, the company is maintaining those two ratios almost near terms, but there is a some slight reduction in current ratio, not up to the 2:1 level. But if you go to the quick asset ratio, it is there. Therefore, we can say the company is good in liquidity. There is no much to worry about as far as the liquidity is concerned. Company is in a good position. Then gearing ratio 1 is below 1, and gearing ratio 2 is below 0.5. Both ratios are declining over the financial years, indicating enhanced capacity for borrowing. Now, if you go to liquidity gearing here, gearing ratio 1 less than 1, 0.69, 0.53, and 0.2 in a decreasing trend. Similarly, gearing ratio 2 less than 0.5, 0.44, 0.39, and 0.35, that's also getting decreasing. Therefore, according to the gearing ratios, we can say this is a low geared company, very highly dependent on the equity capital rather than debt capital. Therefore, this is a one ratio that we focus, that we take into account when we decide our lending structuring facilities. Therefore, the bank is in a position to lend this company because they are highly dependent on the equity capital than debt capital. Therefore, much room available for the banks to lend. That is a good trend. Then investor relation, and investor relation, they talk about shareholder ratios such as dividend cover and earnings per share improving over the period, which is satisfactory. But I have a concern. I mentioned previously also. Here, DPS is almost double, almost triple compared to 2014. They have given only 2 rupee per share. Now they have given 5 rupee per share. Right? Now, if you are increasing the dividend per share, the shareholders in the next year also, they would like to have the same dividend per share. Otherwise, they also will get disappointed. But from the company's point of view, paying dividends means you are taking the entity's funds outside. Therefore, once it is needed, if the entity need any fund, they have two options: either to borrow from the bank or to ask again from the shareholders as a share issue. Right? Therefore, whatever the earnings, if you can retain something for the future, it's better. Now, in 2014, company earned 4 rupees 93 cents for a share. Out of that, they have declared 2 rupees. In 2016, they have earned only 6.4 rupees. 6.4 rupees per share. Out of that 6.4 rupees, they have declared 5 rupees. Therefore, they are only left with 1.4 rupees. That is not good. Whatever the earnings, you have to retain something. Otherwise, for future users of future expenses of the business, you don't have any money. Right? In this table, it is very clearly you can identify. In 2014, here 5 rupees they earn, they declared only 2 rupees, and mean they retain 3 rupees. Here in 2016, they have earned 6.4, but they have declared 5 rupees. That means retain only 1.4 rupees. That is not good. Right? That is a point to we have to make a note of it, and we have to comment on it. Right? Then risk analysis. If you take profitability, their ratios are there were some declines, but we can say medium risk is there. Then liquidity, medium risk is there. There was a concern. If you take the current ratio, it is not that much up to the standard that what we required, but medium risk can be seen. Gearing, very low risk gearing. Shareholder benefit, satisfactory is there. Now, we have to give a final conclusion here. Because of the medium profitability, liquidity risk, and declining interest cover, one has to exercise caution in considering further facilities. Because of high demand for the products of the company, one could expect profitability to increase. In such circumstances, fully secured further facilities could be considered favorably. Here, gearing is very low. You could see the interest cover also a concern, but profitability there was some concern, but taking into account the fact that the company has increase in demand for their products and low geared company, we can say we can recommend further facilities. Now, if you take the further facilities, these are the options that we have under question number that is now if you go to the question number 1, we have answered. I suppose you are required to assess the disposition of MS Fashion Apparel Limited for granting additional facilities using the financial analysis focusing on important accounting ratios. At least 15 ratios we have to calculate. Ratio analysis 15 marks, risk analysis 5 marks. Now this analysis, right, this one is very important. I am allocating at least 5 to 4 marks for this thing. Therefore, don't skip that analysis. You have to make sure that you, after calculating and after interpreting all the things, for individual category of ratio, what is your risk position, whether it is medium, high or low, and final risk position, and whether you consider further facilities or not, clearly indicate in your answer. Right? For this section, in this question paper, for this section, it has been allocated 5 marks, right? Then part number 2, in the above event, in the event of considering the additional facilities, describe the type of facilities you may recommend. 4 marks have been allocated. Right? We'll see. We have a few options. Option number 1. Currently, you can see, use these kind of tables. Currently, you have existing limit of 80 million term loan, 10 million existing for overdraft. Altogether 90 million is there. Percent outstanding is 58 million and 16 million. Right. Proposed limit. Now we have a total limit of 90 million. Currently they have a requirement of 15 million for the working capital and the new machineries. If we propose 59 million term loan, which is in line with the current outstanding, and 16 million overdraft, which is also current outstanding, in line with the current outstanding, and the 15 million for new facilities, then we are within the 90 million mark, which we can accommodate. Right. If I further elaborated, option number 1, consider the existing approved limit of the term loan 80 million. Since the balance in the loan is less than approved limit by 18 million, reduce the limit to 59 million. That's why, that's how we did. From 80 million, we have reduced the limit to 59 million, which is the current outstanding is also within that limit. Right. Then consider new loan of 15 million repayable in 2 years for the current requirement. Increase the OD limit to 16 million and ensure that the company operate below the limit. Right. We can increase the OD limit to 16 million, which is within the current present outstanding, and we have to ensure that the company is maintaining OD limit within that particular proposed limit. And within the 90 million existing limit, we can accommodate these new options and current outstanding also. That is option number 1. Then option number 2, we are proposing a new term loan of 80 million. We are proposing a new term loan of 80 million, and using that new term loan, we repay the current term loan and current overdraft outstanding. Right? Current overdraft and current term loan, the total outstanding is 74 million. 74 million. Then out of this 80 million, we repay those 2 items. Then we are left with 6 million. Right? For the using that 6 million, we can accommodate the working capital requirement, and for the balance, these in machinery machinery requirement, we can introduce a leasing facilities for those two machinery with a limit of 10 million. Right? Again, we are within the limit of 90 million. Right? What we do is we introduce a new loan, 80 million. We repay the existing two facilities, overdraft and the term loan. Then the total outstanding is 74 million. Out of the 80 million, when we repay the 74 million, we are left with 6 million. Right? And with that 6 million, we can accommodate the working capital requirement. For machinery purpose, since we are again left with another 10 million, for two machineries, we can introduce leasing facilities for 10 million. And using the 10 million leasing facility, we can take those two machineries. Option number 2, here I am elaborating further the same option. Company has an approved limit of 90 million. Consider new loan facility for 80 million amount, repayable in 3 or 4 years. Recover the term loan and the overdraft fully. The balance could be utilized for the working capital requirement. A lease facility to be used to purchase the machinery by mortgaging the assets. That is option number 2. Then option number 3, we have a third option also. Now here we consider the new valuation report. New valuation report. If you take the old valuation report, 150 million is there. 150 million, 60% means 90 million. That was the exposure that they have given to the entity. Now, if you take the same exposure, that is 60% for new valuation, they have obtained a new valuation here in the examination question here. Under note number 5, a recent valuation of the property indicated a valuation of 170 million. Right? If you take the new valuation 170 million, take 60% of it, it will be 102 million. 102 million. 102 million. Right? 102 million. Now, using that 102 million limit, we can introduce few facilities. First one, 90 million term loan, and we recovered the present loan outstanding of 74 million using the 90 million loan. Then we are left with 16 million. 16 million we can use for working capital and machinery, and we are now okay for the current requirement. In addition, for the since these companies exporting the things, we can introduce a packing credit facility also 10 million and an overdraft limit of 2 million, very small overdraft limit, and we are okay with the 102 million limit. I will elaborate option number 3. The new value of the property is 170 million. Mortgage value is 60%. It will be 102 million. Approve a new term loan of 90 million. Recover the existing loan outstanding 58 and OD of 16 million. Out of the balance, allow the company to purchase machinery of 10 million and working capital of 15 million, since we are left with 16 million after repaying those two facilities out of 90 million. Then the balance of the limit of a packing credit facility of 10 million and overdraft facility of 2 million to be used if needed. Now, I am not going to explain about what is a packing credit and everything. That is a separate thing. Those things will be separately discussed by the other lecturers. Right. Then that is option number. You are only required to give one option. Here I gave 3 options for the question. Right. Then the last part of the question, they ask, suggest your recommendation to the management of MS Fashion Apparel Limited to enhance the financial position without requesting additional facilities. Now, under last question, they said, now you are in the MS Fashion Limited, right? Without going for a bank loan, propose additional options that they have. If you are in the management of the MS Fashion Limited, recommend few options without asking a loan facility from the bank, what are the options available? Now, these are the options available. I recommend few options, at least 5 to 6 options. First option is the company was paying higher dividend. The point I raised earlier, the company was paying higher dividends in the financial years 15 and 16. The company may pay dividends similar to 2013, by which about 40 million can be saved, which could be used to reduce the credit facility. Now, the first proposal is, if they have paid a dividend similar to 2014, they could be saved 40 million, right? That is 2 rupee per share. Now, if I go to that thing, I'll go to here, right? The question paper here, 16,000 means 2 rupees 8 million. Here, 4 rupees 8 million, 32,000. Here, 5 rupees 8 million. If they could pay 2 rupees dividend here, also they wanted to pay only 16,000. Here also 2 rupees means 16,000. Now here, if they paid 16,000 only, they could have retained 16,000. Out of 32, 16 could have been retained if they paid similar dividend in 2014, in 2015 also. Here also, if they paid only 16,000 dividend, they could have retained 24,000. Therefore, in 2015, they could have retained 16,000. 2016, they could have retained 24,000. Then altogether, 40 million they could have retained by paying a similar dividend equal to 2014. That's the point here I am making. But this point cannot be exercised because that they have already declared those dividends. Therefore, even though I am proposing this point, this is not an exercisable proposal because they have already declared the dividend. Right. Then point number 2, the company could consider a debenture issue of 50 million at a rate lower than the bank borrowing rate. Right. Now, since this is a limited liability company, they could have asked a debenture issue where they should ensure the bank borrowing rate is higher, the debenture issue rate is less than the bank borrowing rate. Because when you are issuing debentures, it will have very administrative works. Lot of administrative works are there. Therefore, compared to a borrowings from a bank, the administrative work of a debenture issue is very high. Therefore, if the interest rate is lower in the bank borrowing case, you don't go for a debenture, right? Therefore, take into account that the second point I am proposing. Point number 3, the company's debtors collection period is almost 1 month. We will go and see whether it is true or bad. True. Debtors collection here. Debtors collection period 30 days. 30 days. Right. That point is correct. Right. The company's debtors collection period is almost 1 month. We may have to offer discount for early payment, which may reduce the profit. A reduction in collection period may not be viable move. Right. If we encourage our debtors by giving a discount, they may also pay early, but when you are giving discount, it will reduce the profit as well. That is an option to consider. Then point number 3, 4, the net asset value of per share of the company is 17.42. That is, if you go to the balance sheet, the equity capital is total equity capital here, equity is 139.4 million. 139.4 million. You have 8 million shares. You divide 139,400 by 8,000. Here also you have to take into 1,000, right? 8,000 in terms of 1,000 shares. 139,400 divided by 8,000. Don't divide it by 139,400. Don't divide by 8 and 6 zeros. Right? You have to take this 8,000 only, because this is also in 1,000 terms. This figure needs to be also in 1,000 terms. Therefore, per share value is calculated by net asset per share is calculated 139.4 million divided by 8 million shares. That is 17.42 rupees. Directors may issue 6 million shares at rupees 16 and realize 96 million. The proceeds of the issue may be used to meet the present requirement and settle all the facilities. If you can raise 96 million, then better, right? Since you are paying higher dividend, no, right? This may reduce the finance expenses, but the company must enhance the profit at least by 12 million, right? Now, when you are issuing 6 million shares means you have a increased dividend per share also. If you declare 2 rupee per share, 12 million profit you have to increase, right? That is another option. Then the final option is because of the high demand for the company's products, and in the case of confirmed orders, the company may request advance payment from the clients who made the orders, right? Don't go to bank. When you have orders, take some advances, right? Ask your foreign clients, local client to make some advance payments. Using those advance payment, you can take the working capital and the machinery that you want. That is the final option I am proposing. Right. That is the end of the first question. If you do have any questions, you can ask. Average capital employed. I'll go to that. Average capital employed. Here. Now, the first part I am not going to explain. That is a net profit before tax and before interest. That is very straightforward. Average equity capital we have calculated in the previous slide. Right here, average equity capital we have calculated here, right? We took that figure directly to the this slide also, average equity capital. Then average long-term debt capital 65,000 for 2014. How do you calculate 65,000? Go to your question. We take term loan as the long-term loans. 80,000 is 2014 figure. And in order to calculate the average one, you need to 2013 figure also. 2013 here, they have given term loan 50,000. 50,000 plus 80,000. 50,000 plus 80,000. Then it will be 130,000 divided by 2. 65,000. That's how I took here 65,000. We go to 2015. Here answer is 74,000. How do you calculate 74,000? Go to question. Term loan is 68,000. Previous year term loan is 80,000. 80,000 plus 68,000, 148,000 divided by 2, 74,000. Here 63,000, how do you calculate? 68,000, 58,000, all together 126,000. ඇටයි 58යි 126යි. දෙකෙන් බෙදනවා. එතකොට 63යි. එහෙම තමයි calculate කරේ. Then you add back the average equity capital and average long-term debt capital. Then you have average capital employed. You just add back. Because all these two figures are average figures, no? Average equity capital and average debt capital, all figures are averages. Therefore, just you need not to again average those things, just add back. Then divide the net profit before tax and interest by capital, average capital employed. Then you have 40.9%, 37.28%, 41.16%. Hope that is clear. Please explain the fourth option of the last question. Right, okay. Fourth option. What is the fourth option? This one. Right. Here we are talking about a new share issue. Right. In order to get an understanding of the issue price of a share, first you have to understand what is current book value of a share. Right. Book value of a share, how do you calculate? Now I will go to the balance sheet. Here the share means the normal ordinary share. Now the equity is the shareholders entitlement. You have 8 million shares outstanding. You have an equity of 139,400. 139,400 equity. Because non-current liabilities, current liabilities, we have to repay those things. This 139,400 is the entitlement of the shareholders. Right? The entitlement is 139,400. We divided by it by 8 million shares. Right? Therefore, 139,400 divided by 8 million. Then you have an indication that one share is value. The book value of a share is 17.42 rupees. Right? By giving a discount, we say 16 rupee per share we can issue. Right? In order to realize about 96 million, 6 million shares, if you issue 6 million shares, 96 million you can take by having a 16 rupee per share. Right? Using that 96 million, you can repay the term loan outstanding and the OD outstanding, and balance you can use for the working capital requirement and machinery purchase. Right? Here also the warrant fact is when you issue new 6 million shares, if you declare next year at least 2 rupee per share, meaning you have a dividend payment of additional dividend payment of 12 million. Additional dividend payment of 12 million because of this 6 new shares issue. Even though you receive fund, these shareholders also will ask for dividend. If you take the minimum dividend of 2 rupees, 6 million into 2 rupees means 12 million. Therefore, your profit needs to be increased at least by 12 million next year in order to accommodate the 2 rupee dividend. That is the fourth option. But here the main thing is the current directors will have to, the major shareholders will have to accept this proposal. Right. We'll have a 5-minute break, 5 minutes or less than 5-minute break. I will drink some water and we'll start the next question within 2 or 3 minutes. Right. Next question is 2016 May question paper. That is a different structural paper. Either first structure or either the question that I am going to discuss will be in your exam. Right. We'll start again because of the time limitation. The second question is 2016 May question paper. Now here the structure is different. You are the credit of, we'll read the question first. You are the credit officer of Alliance Bank PLC. Mrs. MS Alpha Business Solution Limited is one of the leading suppliers of software solution for local and export market and a prime customer of your bank. It maintains a satisfactory conducted current account at your bank with an average balance of LKR 10 million. At present, it also enjoys the following credit facilities. The structure is very almost similar, but there are some differences when you compare with the question that we have already discussed. Approved limit 80 million, current outstanding 62. Approved limit 20 million, current outstanding 26 million in case of overdraft. Alpha Business Solution has plans to expand its business. Recently, the company had signed 3 contracts, 2 of which are from overseas clients, to deliver software solution within the next 6 months. In order to meet this requirement, the company has to purchase 6 computers and recruit experienced staff. The company requires additional facility of 10 million to meet the working capital requirement. The Chief Financial Officer, MS Alpha Solutions, had approached your bank for additional facilities to meet their requirement. You as the credit officer had requested for the income statement and financial statement, position statement of the company for the years ending 31/3/2014, 2015 and 2016. The summarized audited results of 31/3/2014, 31/3/2015 and unaudited financial results of the year ending 31/3/2016 are given below. You have to make a note of it. 2016 figures are not yet audited, unaudited figures. An income statement given. Similarly, the balance sheet also given. Here, the one of the differences, instead of inventories, you have work in progress stocks are there. And 6 million ordinary shares also there. If you go to the additional notes, work in progress is the cost of work performed, not invoice. Therefore, that is also take into account the cost is the work in progress value. Very few notes have been given. First one is you may assume that the trade receivable, trade payable balances reflected in the balance sheet are average balances. Right? You may use year-end figures in the financial position statement for computation of ratios. Here, the examiner clearly asks you to calculate or use year-end figures, right? Not asking you to calculate average figures. Therefore, no need to calculate average figures in this question, right? If you are to calculate a ratio, one figure from the income statement and another figure from the balance sheet, normally we take the balance sheet figures as an average. But in this question, he has not given figures or data to calculate the average figures. He is asking for you to take the year-end figures as average figures and calculate the ratios. Therefore, that is very straightforward. Therefore, don't waste time. If the examiner asks for you to calculate using the year-end figures, take that option. Then the company has issued 6 million voting ordinary shares. The market value of the value per share is also given at the close of business every financial year. 2014, 18 rupees, 2015, 19.50, 16, 24 rupees. Now the examiner asks following ratios. Therefore, no need to worry about other ratios. You directly take these ratios and calculate, right? Profitability, GP, NP, return on equity, return on capital employed. Then liquidity, current ratio and quick asset ratio. Then gearing, gearing considering long-term borrowing, gearing ratio 1, and gearing considering long-term and short-term borrowing, gearing ratio 2. For investor relation, earning per share, dividend per share, earning yields and dividend yields. And they have not asked any ratios relating to working capital. Then for that ratio calculation, 18 marks have been allocated for 12 ratios. Based on the results of the computation and above, state brief comment on the financial analysis and explore the risk position of granting additional facilities to Alpha Business Solutions. 5 marks allocated. Then number 3, in the event of considering additional facilities, describe the type of facilities you may recommend. Right, we'll directly go to the answers. Whenever we want, we refer the examination questions. First, we'll calculate the ratios. First ratio is GP ratio. I am not wasting much time on these calculations. GP ratio, easily you can take the figures, gross profit and sales. From the income statement, it's given the gross profit and the sales. Gross profit and the sales. Here you can calculate gross profit and sales. You calculate the GP ratio. You can see the first ratio, first year 34%, second year 37%, third year 36%. Right. There is no much difference between the gross profit ratio, but you can see a similar trend. I don't have nothing to explain how to calculate gross profit ratio here. We'll use the interpretation part at a later stage when we are commenting, but here also we can say same ratio is being maintained by the client. Then they ask net profit ratio. Net profit ratio, you have to make sure that you are taking the correct net profit from the income statement. Don't take the last item I mentioned previously, also previous question also. Don't take the last item. Instead, you have to take the net profit after tax. Net profit after tax. Right. Net profit after tax also, here you can see very lower rate. 6% means very lower rate, less than 10%. In 2015, there was an increase of 8%. But again, in 2016, it has declined to 6%. we have to first calculate. I think there is no cumbersome process in calculating these ratios. Very straightforward. You have to directly take the question net profit after tax and divided it by sales. If you do have any issues, please ask. I don't think any issues can be found in these calculations. Very straightforward. Then return on equity. Here also you have to take into account the examiner, what the examiner proposed. Don't take any average balances, take the year-end balances, right? Year-end balances, just take the year-end balances, right? When we previously calculate the return on equity, previous question, we have to calculate the average of equity. Here in this question, since we are not given the figures of 2013, we cannot calculate the average equity balance. We can only calculate the, we can only get the year-end figures, right? Give me 1 minute. Give me 1 minute. Right. When I was discussing about the question, I closed that examination question. That's why I took some time to again upload it into the session. Now here, average, no need to calculate the average equity. You just have to take these equity figures here. 108,000, 136,000, 156,000. I took that things, right? 108, 136, and 156, and divided net profit after tax by equity capital and calculate the ratio. It will be 26%, 40%, and 35%. Right? 26%, 40%, and 35%. Right? Then return on capital employed also, similarly, no need to take average balances. Take the net profit before interest and tax. Right? Before interest and tax. Very straightforward. It is their net profit before interest and tax here. 54, 95, 114. I took the same figures here. Then equity capital and long-term capital. Equity capital, previous slide, we can directly take equity capital. Long-term debt capital, go to your balance sheet. Long-term debt capital, balance sheet, long-term debt, non-current liabilities here, 30, 78, 62. 30, 78, 62. 30, 78, 62. Then add those two. Capital employed is the answer. 108 here and 30, 138 here, 136, 78, 214, 156, 62, 218. Then divide this figure, net profit before tax and interest, by total capital employed. Then you have answers. Answers of 39%, 44%, and 52%. Right, 39%, 44%, and 52%. I think there is a mistake in 2016, 62,000 divided by 118. No. 114 divided by 218. 52. No, all answers are correct. This item, this 54, 95, 114 line should be divided by capital employed, right? Then you arrived at these figures, that is 39%, 44%, and 52%. Do you have any question? You can ask. Currently, no questions have been asked. Right. Then interest cover. You have to take the net profit before tax and interest. Net profit before tax and interest. Directly you can take. Here also I take the same figures. Net profit before tax and interest. Net profit before tax and interest here. 54, 95, 114. Directly from the income statement. 54, 95, 114. Then take the interest. 18,000, 28,000, 42,000. 18,000, 28,000, 42,000. And divide the net profit before tax and interest by interest. Then you can find answers. 3 times, 3.39 times, 2.7 times. Higher the number, better it is. You can see it's almost 3 times every year, but there is a slight decrease, but almost 3 times in every year. Right. Then current ratio, these are very easy to calculate. You have to directly take the current assets and current liabilities. Go to the balance sheet. Current liabilities and current assets here. Total current assets and current liabilities. Current asset 41, 66, 86. 41, 66, 86. Current liabilities here 23, 44, 23, 32, 44. 23, 32, 44. Then divide your current assets by current liabilities. And answers will be in 2014, for one current liability, you have 1.78 current assets. In 2015, for one current liability, you have 2 current assets. In 2016, for one current liability, you have 2 current assets. Very acceptable. Then quick assets ratio. To deduct the inventories from the current assets, and you have quick assets, then compare it with the current liabilities. When you calculate, the answers will be for one current liability, you have 1 quick asset, and for all 3 years, for one current liability, you have 1 quick asset. Very acceptable. Here also no need to take average. Normally, you won't take averages for all the if all figures are taken from the balance sheet. Anyway, this question, you are free to take the year-end figures instead of average figures, because the examiner didn't give the required figures for you to calculate average figures. Right. Then gearing ratio 1. For the first gearing ratio, take the equity capital and the long-term debt capital. I'll go to the balance sheet. First, we take the long-term debt capital. Here, long-term debt capital means only we have non-current liabilities, term loan, 30,000, 78,000, 62,000. Yeah, I took 30, 78, 62,000. Then equity capital. What is the equity capital? Here, 108, 136, and 156. 108, 136, 156. Then divide the long-term debts by equity capital. Then you have 0.28, 0.57, 0.4. All are less than 1. All are less than 1. Then it's a low-geared company. Our equity capital is more than the debt capital, long-term debt capital. That's why we have a less than 1 ratio. Then gearing ratio 2, you have to take not only the long-term debt capital, you have to take the short-term debt capital also. Long-term debt capital we have already taken 30, 78, 62. Then go to your balance sheet, take the short-term debt capital. Now here, short-term, you have 2 debts, that is creditors and bank overdraft. I mentioned in the last question also, don't take creditors. We are not considered as a debt capital, short-term debt capital, the creditors. We have to take only the bank overdraft and the short-term loans. I took only the bank overdraft, 11,000, 18,000 and 16,000 as short-term debt capital. 11, 18 and 16. Then you have total debt capital of 41,000, 96,000 and 88,000. Then equity capital we have already taken into account in the previous calculation. Then you can calculate the total capital. Total capital. Total capital is 149, 232, 244. Right? Now compare your total debt capital with total capital. Total debt capital with total capital. 41 divided by 149. Then it will be 0.28. 96 divided by 232. 0.41. 88 divided by 244. 0.36. All are less than 0.5. All are less than 0.5, meaning low geared company. Low geared company. Low geared company. Take the logic into account, then you can easily calculate any sum, right? Under first ratio, we took long-term debt to equity capital. In the second ratio, we take short-term and long-term debt and take the total debt capital. And total debt capital, compared it with the total capital, not the equity capital, total capital. Right? Correctly understand the ratios, right? Okay. Those are the gearing ratios. Then investor relation ratios, very easy to calculate. Earning per share, take the net profit after tax. Here, number of ordinary shares also, we have to take that number also into 1,000 terms. That's why I put here 6,000. 6 million ordinary shares are there. 6 million into 1,000 means 6,000. Right? Therefore, net profit after tax divided by number of ordinary shares. Then the earning per share is rupees 4.83, 9.17, 9.33 earning per share. Higher the earning per share, better it is. Right. Next one is dividend per share. Take the total dividend. It's there in the question. Total dividend. Here. 18,000, 27,000, 36,000. Total dividend. Then divide it by number of ordinary shares. 18, 27, 36 deduct by 6,000 ordinary shares outstanding. Yeah, I skip last three zeros because this figure is in 1,000 terms. Therefore, this figure also needs to be in 1,000 terms. Then dividend per share is 3 rupees, 4.5 rupees. Then final one is 6 rupees per share. Per share dividend 3 rupees, 4.5 rupees, and 6 rupees per share. Right. Then next one is earnings yield. Earnings yield. How do you calculate? You have to take the market value into account. Take the earning per share, divided it by market value per share. It is given in the exam question. Right? Market values of shares, they have given here. 2014 18 rupees, 2015 19.5, 2016 24 rupees. Earning per share, a moment ago you calculate in the previous slide. Earning per share divided by market price per share into 100. Your earnings yield will be 26%, 47%, and 38%. Higher the value, better it is. Right. Next ratio is dividend yield. Similarly, dividend per share divided by market value per share. Dividend per share divided by market value per share. Dividend per share you have already calculated. 3 rupees, 4.5 rupees, and 6 rupees. Market value per share you have to take from the notes. Previous ratio also we have taken into account. 18 rupees, 19.5, 24 rupees. Then divide the dividend per share by market value per share into 100. Now these ratios are very easy to calculate if you know how to calculate, right? Only 16%, 23%, and 25%. Higher the amount, better it is. Higher the amount, better it is. Right. Now, I suppose we have calculated all the ratios that was requested by the examiner. Now, these are the summaries. If you go to the profitability, gross profit ratio, it's almost 34, 35, 36, 37%. The net profit ratio, we have a concern. It's very below the 10%, almost 6%. In ROE, there is increase in trend, acceptable. ROCE also increase in trend and acceptable, well above acceptable ratios. Interest cover, there is a decline, but 3 times is very acceptable. Then liquidity and gearing, liquidity very acceptable, almost near terms 1:2 and 1:1 as far as the current and quick asset ratios are concerned. Then gearing ratio also very acceptable, low geared company. 2 ratios also suggest that a very low geared company. Very there is a very high room for more lending because the companies materially relied on the equity capital than the debt capital. Therefore, as a bank, we can lend more. Then investor relation, EPS increasing, DPS also increasing. We have a concern there. If you take 2014, 3 rupees, now they have declared double DPS, 6 rupee per share. In 2014, 4 rupees earn, 4 rupees or 5 rupees earn, 3 rupees declared as dividend. In 2016 also 9 rupees earn, 6 rupees declared as dividend. The retention is very minimal. Dividend yield and earnings yield very high because of higher earning per share and higher dividend per share. Right. Now, if you go to the question, first we have to calculate these ratios. Second, we have to give our opinion based on the risk. We'll see that part. Interpretation and risk analysis. To take the profitability, it may be seen that GP, NP, ROE and interest cover ratios increased in financial year 2015 but declined in 2016. It may be attributable to the fact that the expenses increased by 1.35 compared to the increase in gross profit by 1.25 over the previous year. However, ROCE recorded an increase over the 3 years. But here, my main concern is, even though it is not written in the slide, main concern is lower NP net profit ratio. Lower net profit ratio, that is less than 10%. Less than 10%. Lower net profit ratio is there, right? We have to see whether why it has been such lower, whether it is industry level or whether this is company specific. Right. Then liquidity, we cannot say anything because liquidity is very good in this company, near norms in the 3 financial year, 1:1 and 2:1, quick asset ratio and current ratio. Then gearing also very acceptable, low geared company. Gearing ratio 1 is below 1 and gearing ratio 2 is below 0.5. Both ratio decline over the financial year 2015, very acceptable to a bank. Then investor relation, shareholder ratios such as earning per share and dividend per share are improving over the period, which is satisfactory. Although both earnings yield and dividend yields improved in 2015, both declined in 2016 due to increase in market prices as at 31/3/2016. But we have a concern, higher dividend per share is given. Take into account all the things that we have discussed. Profitability, medium risk is given because GP is high but NP is lower. Therefore, profitability low risk cannot be given. We can say medium risk. Liquidity low risk, gearing low risk because liquidity and gearing are very acceptable. Shareholder benefits very satisfactory. Therefore, further facilities can be considered favorably. However, we must obtain the audited financial statement for the year 2016 before releasing the funds to approve facility, because these are based on draft account, not the audited financial statements. Right. The options are under third question. In the event of considering additional facilities, describe the facility type of facilities you may recommend. Right. Go to option 3, question number 3. First option. Now, if you go to the question itself, now they have requested. They have a limit breaches of 6 million as far as OD is concerned. And in addition to that, for staff and for 6 computers, they need 6 million. Therefore, we can see how we can breach those requirements. Currently, they are enjoying 100 million limit. First option is we are proposing a new loan of 80 million. New loan of 80 million and 20 million overdraft within the 100 million limit, and using the 80 million new loan, repay the 62 million existing loan and additional exceeding limit of OD, right? For that thing, you need 62 plus, now we are proposing 8 million reduction. 62 plus 8 means 70 million, and you are left with 10 million for the proposed 6 computers and additional experienced staff recruitment. You are left with 10 million, right? And by reducing the existing limits overdraft 26 by 8 million, you have a 18 million current outstanding, and 10 million you can use for the requirement that you need. Here it is further explaining. Consider the existing approval limit of the term loan 80 million. Since the balance in the loan is less than the approval limit by 18 million, consider a new loan of 80 million repayable in 3 or 4 years. Recover the existing outstanding of 62 million. Allow the company to utilize the 10 million to purchase the computers and reduce the overdraft by 8 million and bring below the limit. Right? I think very easy to understand. The second option is, if you go to the second option, we propose 62 million, the proposed limit of the current outstanding of the existing loans, and balance 38 million for the overdraft, right? If you take overdraft, current outstanding is 26. If you propose 38 million, you are left with 12 million excess. And 12 million excess, you can use that for working capital and other requirement that they want 10 million. That is the second option. If you elaborate that thing, consider new loan facility of 62 million to meet the current outstanding, increase the OD limit by 18 million, increase in the original approved limit, the company can lease the computers and meet the lease rentals from the increased OD facility and use the facility to meet the working capital requirements. Right. Since 2 of the contracts signed are from the overseas client, we could request the supplier to open letters of credit through your bank and consider granting facilities against them, right? That is another option or facilities can be considered. LC facility you can consider, because overseas clients are there. No, you can ask the company to have opens via your bank, and you can take facilities into account. The directors may consider to expand the business considering the overseas opportunities, considering the company. Consider the company going for a 1 million share issues, 20 million, sorry, 1 million share issues issued at a 20 rupees per share. Approximately 20 million may be used to meet the present requirement and reduce the overdraft limit. Without going for new facilities, company may issue a 20 million share issue. Now, if you go to the balance sheet, the current book value of a share, now our equity capital is, how much our equity capital? 156 million. And you have 6 million there, right? 156 divided by 6 million means 26. 26 is the book value of a share, right? Now here we consider 20 rupee per share. Since book value is 20 rupee per 26 rupee per share, we can consider a issue price of 20 rupee per share, and we issue 20 million worth of shares, that is 1 million shares, and take the 20 million and repay the OD and take balance 10 million to our requirement. And here we will have to at least if you declare a dividend, that this additional 1 million we'll have to take into account when you declare dividend also. Make sure that your profits will be increased at least by that amount next year. Right. If you do have any question, you can ask now.
So when we consider the second option,
Yes.
enhancing the POD limit,
Yes.
why we are not keeping the POD limit as 20 million and propose an additional term loan of 18 million?
Yes, you can use that also. Now, there is no hard and fast rule when you are proposing limits, right? That is also good option. You can use that as a third option also. Good suggestion. I am just proposing because you are good at proposing various proposals. Either you can stick to current limit and consider the proposal given by the client, or you can come up with a new proposal and make sure that the client's requirements are met. Any other questions? But in the exam, you have to give only one option, right? Don't waste your time because and other thing is make sure that you give additional time for this question, because when I am marking, I show some people, they are just mere I don't say the bulk of the people, at least 5 to 10 people, they don't have enough time to complete this question, right? Even though this question attracts more marks and easy to get these marks, and I am also willing to give marks, and all the criteria are there, you don't have time to complete this question because you are finally attempting this question. My proposal is, if you are given the question paper, this is the first question that you should answer, because you answering this question, you can get the minimum marks that you want to pass the exam. Normally we will give 30 marks. Out of 30 marks, without much effort, you can at least get 20 marks. Because structure, because of the nature of your people, and I know for sure that you are very hard working for the exam. Because of that, I am not giving different structures, right? I know for sure that your people are very lazy people, and I am not in a exam by exam. I am not changing the structure of the paper. If I change the structure of the paper, definitely more failures in the students. Therefore, make sure that you stick into what I taught and get this question first attempt and complete the question, because you need to get minimum marks in order to complete this course for this section also. Not only this section, the balance part also, you need to get a minimum mark. Any other questions before I wind up? Why we take profit before interest and tax, right? When you're calculating ROCE here, wait. Yeah, why we take before interest and before tax, because here we are considering the return for entire capital. Here capital employed, entire capital consists of equity capital and debt capital, right? When you want to see the return for debt capital, we are paying interest. That's why we add back the interest. For equity capital, we have to pay taxes also. That's why we add back taxes also, right? When you want to know the actual return of anything, now here the anything means the capital employed, right? The total capital employed, the first we have to take before deducting anything, what is the return? That's why we add back the interest. That's why we add back the taxes. That's why we take net profit before tax and before interest and compare it with the total capital employed. I hope that I answered the question. And the other thing is, I will give my mobile number. It's note 772 note 9 note 89 note. Note 772 note 9 note 89 note. If you want any clarification, you can contact me. Normally, I'm a busy person. If I am not answering the phone, you can contact again and again. But anyway, if you do have any question, if I am not answering for you, just WhatsApp or text me, then I'll get back to you. The important point is you have to calculate these questions yourself. Since this is an online session, it's very difficult to satisfy all the requirements, right? We are also working with the minimum resources in the sense we are very strict into the things. Whatever the calculations, everything, we have to do it in online, right? If you do have any questions, if you do find when you calculate in the actual scenarios, if you do find it difficult, please let me know. I can help you. And for the exams, I will wish you all the very best and make sure that you allow me to give some marks in the exam. Make sure that you write something in the examination paper. Make sure that you attempt this question early possible, right? And if you don't have any other questions, I can wind up the session. Now there is a question. I suppose this question related to 108. 108 means what? Wait. Here, when ROE is calculated for 2014, 108 million is considered as equity figure. Since 2013, equity figures are not available. You are talking about, I suppose, this question, the last question I took. $108, right? එතන 108 ගත්ත කියලා කියනවා යා. හරි. එතකොට එයා අහනවා එහෙමනම් but why don't consider average equity figures in calculating ROE for 2015 since right? No way. No way, because if you consider here only the year-end figure, it has to be very consistent. In 2014, you cannot take one figure and take as equity capital, and 2015 you cannot have average figure. You cannot have average figure, right? මෙතන 108 ගත්තේ අපි එක ෆිගර් එකක් අරගෙන මෙතන 136 ගන්නකොට තව ෆිගර්ස් දෙකක් අරගෙන ඇවරේජ් කරන්න බෑ. ඒකටත් ගන්න වෙන්නේ year end figure එක තමයි. ඒක තමයි consistency කියලා කියන්නේ. එයාගේ question එකේ තියෙන්නේ 2015 වල ඇයි අපි average කරලා ගන්නේ නැති කියලා. average කරලා ගන්නවා නම් මේ දෙක තුනම ඔක්කොම average කරලා තමයි ගන්න figures ගන්න ඕනේ. එහෙම නැතුනොත් එම consistent නැති වෙනවා. ඔයාලට ප්‍රශ්නයක් තියෙනවා සිංහලෙන් හරි කමන්නේ අහන්න ඕනෙක් කෙනෙක්. හිතේ තියාගෙන ඉන්න එපා. Will the papers only be in these two structures only? එහෙම තමයි හිතාගෙන ඉන්නේ. ඔයගොල්ලන්ට වෙන structures දුන්නොත් එහෙම ඔයගොල්ලෝ ගොඩක් කට්ටිය fail වෙන නිසා. I will stick to these two structures, right? හරි එහෙනම් ඔයගොල්ලන්ට අපි විභාගයට සුබ පතනවා. All the best. If you do have anything to ask, please contact me. And then all the very best for your future endeavors. Thank you for participating in this course, and thank you for the support given. Thank you very much.